Welcome back to another episode of FPO&G, Financial Planning for Oil and Gas Professionals. This week on the podcast, we're going to talk about the case for international investing, or maybe more aptly, the case for global diversification. And I think this is really timely because this is candidly the number one question we get on investment portfolios is allocating internationally. And again, what we're not saying is, hey, go all in on international or ignore the US equity markets. The US equity markets are the majority of global stock markets. And so we're not saying ignore the US, but hey, just consider investing and diversifying globally. And most, asset managers have some amount of allocation to international, and their allocations across developed markets and emerging markets, may shade up or down depending on their investment convictions. But it's important to build your convictions of, hey, what allocation do I want internationally? It doesn't make sense to invest internationally. And, we get this question about international a lot because candidly, the last 15 years, investing internationally has made little sense, right? The U.S. has outperformed the globally diversified portfolio that owns the U.S. and international pretty handsomely over the last 15 years. But preceding those last 15 years was 10 years of international outperforming the U.S., known as the lost decade from 2000 to 2009, where the U.S. stock market had no positive return. It was flat over a 10-year period. You would have been better off sitting in cash. And so, the U.S. has outperformed international markets over the last 15 years. And it makes sense. U.S. companies are growing earnings faster. And, there's not really an international equivalent of the Mag 7 abroad, right? The technology companies in America, their ability to innovate, acquire companies, return capital to shareholders, and just operate at a high margin and a high level is really kind of unprecedented internationally. But as Eugene Fama would say, the stock market is a giant information processing machine. And we would argue that all of these things are reflected in the current prices of the stock market. So what a lot of people get wrong is the misconception that, hey, international stocks have to become America for the US to outperform. And that's not true at all. It's all about what information is being priced in and i.e. what expectations are being set for these companies in these countries going forward. So the US equity market's really the A student, right? Like it's outperformed handsomely. It's done really well. Expectations are very high. So even a B plus in terms of business and economic performance and stock performance would be a little bearish for the US stock market because, expectations are unmet. So there might be a re-rating of stocks, and that might be bearish for stocks. Conversely, ex-US, let's take Europe as an example, is probably a D plus student. You could probably pontificate several reasons as to why investing in Europe makes no sense. And we would argue that's part of why the valuations are where they are. And we'd argue that information is reflected in the current price. So, we'll call Europe a D student or a D plus student. So even a C minus might be bearish for European equities because they exceeded expectations because the expectations are so low. And so we might just introduce the idea of, hey, what does international investing look like? And it's very timely that we're talking about this because we're recording this in March of 2025. And, the benefits of international diversification have kind of been on display this year. And of course, a 2.5-year time horizon isn't a meaningful amount of, time period to track, but it is helpful to just kind of see that, hey, these things don't all move in tandem. And yes, US companies do business internationally, but their markets don't move in lockstep with one another. So March of 2025, as we said, year to date, the total return for the S&P is down about 3.5%. And conversely, the MSCI ACWI, which is the All Country World Index, ex-US market, so it's pretty much everything developed in emerging markets, is up about 7% year to date. So there's a 10% spread in the returns of international stocks versus US stocks. And so it's a good time to record this and to introduce the idea of, hey, international diversification makes sense. So with that, let's get into the resource Justin shares.
Welcome in. Want to do a quick video here and talk a little bit about international markets, how we think about portfolio allocation on the macro level. And, ultimately, let's just call it like it is. Investing in international equities has been a pretty painful exercise for a long time, which begs the question, why in the world am I doing it? Why would I invest in international companies? Why am I not putting an outsized bet, a larger bet on U.S. companies moving forward for the next, let's say 5 to 10 years? And I do want to preface this. I think it's really helpful to delineate part of the why behind portfolio construction. When you look at every major asset manager in the US, it is interesting to know that the vast majority of asset managers include and not a majority, it's still a minority position, but they include a very healthy chunk in international stocks. So why are they doing this? For a good 15, 16 years, we are seeing the US trounce international stocks. It really hasn't been close. And so why is every major asset manager, if you hand them a bucket of money to manage, most of them in any sort of managed account, they're going to allocate somewhere between 25 and 40% to international stocks. And that's just of the stock portion. So if you have a 70% stock, 30% bond portfolio, it will be less. But if you isolate just the equity portion of a portfolio, you're typically going to find any major asset manager putting somewhere between 25 and 40%. So why are they doing that? Why do we do that? And I think a huge reason is the why behind investing. And what I'm getting at is most investors do not have a situation where they can simply invest with the highest possible return in mind. Now, I realize that sentence sounds utterly ridiculous. Why in the world would someone invest without their primary objective being maximizing returns? And I would submit to you, and I would really think through this, that for most people, even most institutions, so even institutional investors will often have distribution requirements, meaning they are not investing a sum of money for an endless period of time. Instead, they have to take, whether it's consistent withdrawals of the same portion every month, every quarter, every year, or just different amounts intermittently. Most investors, whether it's an individual or an institution, they do have some sort of withdrawal needs. Think about just the regular family that's investing, and consider someone who is 60 years old. Pretty classic scenario there. They're on the verge of retiring, or they already have retired. So they are not just investing for return. No, they're investing in order to be able to take distributions. And their primary objective is really not the highest return over the next 30 years. Their primary objective is really making sure that retirement income is sustainable, that it's reliable, that it's secure. And if you want an example of this, look no further than why in the world would anyone invest in bonds? When you look at the last century, the amount of time periods, meaningful time periods, so 10, 20 years, the amount of 1 or 2 decade windows in history where bonds have outperformed stocks is very small. The amount of time periods, decades, where cash has outperformed stocks, extraordinarily small, very, very rare that you see that. And so a retiree or a family investing with the goal of having income to live off of, so they're living off of their money, their number one objective is not return. Their number one objective is the safety, the reliability, the sustainability of their withdrawal rate. So let's move in and let's talk a little bit about this. Now, first and foremost, I do think it's critical to understand that when you're investing, if you forego international markets, that is a sizable chunk of the investing universe. So that is a massive active bet. So you think about, as an investor, are you an active investor or a passive investor? And there's just piece after piece over the last 10 to 15 years has warned you to not be an active investor. So there's just so many warnings out there, and this is a good thing, warning investors that active investors are going to charge significantly more money, and there is absolutely no guarantee that they can beat the market, and most of them don't beat the market. Therefore, the application there is you should be a passive investor. And there's a lot of truth to that. Love that thought. Now, it is interesting if you really take that in a literal sense. If you forego 40% of the global equity market, that's not just an active bet. That is a wildly active bet. So you are not remote. There is nothing passive about your investment philosophy if you exclude 40% of the global universe of publicly traded stocks. Now, these next slides are going to get into more of why it's really a wild active bet to do that, particularly in today's world. U.S. stocks are historically expensive. When you have a 15-year window like we've had, the result of that is not unexpected. The result of that is, well, we're now 16 years into unbelievable performance for U.S. stocks. Therefore, the price that you're paying for the earnings that you receive is incredibly high in the U.S. And so you think about forward-looking PE here, 21.5, where the 30-year average is noticeably less than that. And so every metric that you're looking at, you are staring at a U.S. stock market that is significantly more expensive than it normally is. Helpful to always remember, as an investor, you are buying earnings. Future earnings are what you're interested in. Future earnings are what you're purchasing. Future earnings are the reason why you buy companies. And so, it's not a complex idea. If you want to be a really tremendous investor, you're probably going to be agnostic as to where those earnings come from. Do you really care whether it is a utility company, an oil and gas company, a consumer defensive company, or a technology company that provides you these earnings? Well, you probably don't care. You just want the earnings. And so if you are having to pay more for earnings in a certain category of stocks, it's very compelling to not do that, or at least make sure that you do have exposure where earnings are a little bit more attractively priced. And, again, just the most simple idea in investing. The price you pay absolutely matters. So again, if you are buying earnings, if that's what an investor is doing, if you are purchasing future earnings, if you can purchase the same amount of earnings for a lower price, eventually you are likely, history tells you, you're likely going to be rewarded for doing that. Now, I want to tie this back into the big why around why you invest. So again, you are a family that has a budget and you are living off of your assets. What's really interesting about that actually applies to more or less just about everyone. So I would make a strong argument that the retiree with $250,000, obviously that's a critical case where they need to carefully manage that money and have a very sustainable withdrawal rate, watch their budget closely. But what's interesting is if you have $2.5 million, that's also true. It's a pretty classic retirement case. If you have $10 million, it's also true. But even if you have just an unbelievable taxable estate, you still have a portion of your estate that is going to provide for ongoing living expenses over a 20, 30-year window. Navigating an appropriate withdrawal rate within that portfolio is still critical. So no matter who you are, whether you just have an endless portfolio or a more normal sized retirement portfolio, the reason or the most important objective for your investments is not highest 30-year return. The most important objective is making sure that your distributions, that your retirement income is secure, stable, reliable. And so when you think about entering into a period of life where you stop working, you're entirely dependent on your portfolio, it's critical to understand that, hey, a lost decade of returns can absolutely happen again. So from 2000 to 2009, and a lot of you probably already know this, but the S&P 500 did not see any real return. It did not see any return, period. Get the word real out. So it completely flat for a decade, actually slightly negative. In other words, you made more money just putting your money in a checking account with effectively, almost no interest being earned. That was more successful for this 10-year window than the S&P 500. And so there is no guarantee that the previous 16 years are going to continue. In fact, again, you think about, well, what happened before this lost decade? So you go back to 1999 and think about the beginning of the 2000s. That's the dot-com bubble. So the 90s were an incredible decade in U.S. stocks, unbelievable growth. And as a result of that, at the end of the 90s, the price that you're paying for the earnings you receive from those companies was unusually high. Am I predicting that we're going to have a lost decade in the U.S. for the next 10 years? No, I'm not predicting anything. I have no idea what's going to happen. Really can't emphasize this enough. All of the 10-year forecasts that you see, whether it's Goldman Sachs, whether it's Vanguard, anyone, they're just not worth anything. No one knows what the next 10 years are going to be like in the stock market. But you do need to have an awareness that these time periods can happen. So again, if your primary objective with a sum of money is that you're going to live off of this money, well, then you have to take into account, how will I live off of this money for a 30, 40-year time period if we have a decade at the beginning where we don't have any return? So again, what's interesting here, I made the comment at the beginning, your primary objective, the reason why you invest is not to get the highest return over a 30-year window period. So take this. Pretend that the U.S. stock market continues, or pretend that it has a 15-year window where it does not make any money. But on the back 15 years of this 30-year stretch, pretend that we have a 15 years like we've had since 2009. Well, you're going to be in a world of hurt. In that scenario, you're going to have 15 years of rising costs, rising distributions from your portfolio, and the returns are not going to be there. And so that's a big reason why you include international positions. Obviously, markets ebb and flow over time, and the ability to rebalance, the ability to get dynamic and not robotic with your withdrawals from your portfolio is critical. Another way to say this, imagine that you have one position in your portfolio that you're taking income from, and I just mentioned, well, what if for 15 years, what if it's flat? What if it does not produce any returns? What if it's negative? That's going to be a very difficult retirement income plan. It's going to be a difficult distribution plan. On the other hand, if you have several different positions, there are so many options to harvest, to rebalance, and to take income from some of the better positions while some of the laggards can recover. You give yourself a tremendous amount of flexibility for retirement income there. Valuation spreads right now. So we talked about the fact that, hey, if you're an investor, you're interested in future earnings. When we discussed the fact that the U.S. earnings are quite expensive currently. International earnings are not. And so a lot of investors view Europe and they look at Europe thinking, well, how in the world am I going to invest in Europe? The U.S. is so much more compelling right now. The tricky part is that is priced in. Europe's incredibly cheap. My partner Jared, he made the comparison, and this is an apt comparison. Europe is a D student. So if Europe for the next few years produces D+ results or C- results, that could be a very positive thing as an investor, whereas the United States is an A student. And so if the companies in the US produce A- or B+ results, that's a negative thing. So Europe does not need to, attain the production and the level that the U.S. is at in order to be a very positive investment. These are just some quick thoughts on U.S. international. I think the same thing applies not just between U.S. and international, but between different parts of the U.S. market. So U.S. large technology companies are where most of the returns have come from. There's other parts of the U.S. market that are significantly more attractive in their current price. And that's a big reason as to why so many asset managers preach diversification, because there's very few individuals, families, or institutions that have the luxury of investing without ever taking distributions. And we'll cover this more, so we'll pause it for there, and we will pick it up next time.